All right, today we're going to run a little thought experiment, a what if that looks at a sudden, pretty catastrophic shift in the global financial system. You know, the kind of thing that could change the price of, well, everything you know. So let's dive in. Seriously, just imagine it for a second. You wake up tomorrow and the cost of your coffee, the gas in your car, your rent, it's all different. And not just by a little, but by a lot. And the craziest part? It has nothing to do with anything your country did. It's all because of one single decision made halfway around the world. And look, this isn't some sci-fi plot. The architecture that could make this happen is very, very real. In our scenario, the thing that kicks this all off isn't a bomb or some big declaration of war. No, it's much, much quieter than that. It happens in a conference room, during a press release, of all things. You know, the most profound shifts in power, they don't always start with a bang. Sometimes it's just a simple change in the rules of the game. The trigger is one single word, also. It seems totally harmless, right? But in the world of global finance, that word is an earthquake. Because what the market hears, what every trader on the planet hears, is that the US dollar has just become optional. And that changes everything. Okay, so let's unpack exactly how this one little word sets off a massive chain reaction. We're going to look at the immediate impact on global markets in those critical first 3 days. So the announcement comes from the BRICS nations. That's Brazil, Russia, India, China, South Africa, and their new partners. They reveal a new joint currency. But honestly, the real bombshell, the part that makes everyone's head spin, is that last point. Saudi Arabia, the absolute linchpin of the oil market for 50 years, says it will also accept this new currency for its oil. See, they didn't ditch the dollar, they just gave the world another choice. And the reaction is just immediate. The first hour is pure denial, but within 24 hours, the dollar drops 4%. Now, that might not sound like much, but in the currency world, that's not a dip. That's a giant signal flare lighting up the sky. By hour 72, the panic is real. And the US Federal Reserve has to ask a question they never, ever thought they'd have to answer. What do we do when the world no longer needs our currency? To really get why this is such a massive crisis, we have to pull back the curtain and understand the hidden engine that's been powering the global economy for the last half-century. It's this self-reinforcing loop. Let's break down how it worked. For decades, the system was a thing of beauty. Step 1. If you wanted to buy oil on the global market, you had to use US dollars. Period. So, step 2, every country had to stock up on massive piles of dollars just to be able to buy energy. What do they do with all those extra dollars? Well, that's step 3. They'd buy US Treasury bonds, which is basically just lending the money right back to the US government. And that created step 4, constant built-in demand for US debt, which kept America's borrowing costs incredibly low. It was, for America, the perfect cycle. But that announcement we talked about, that one little word also, it doesn't just damage the loop. It shatters the first and most important link in the chain. If countries don't need dollars for every single barrel of oil, the entire self-reinforcing system starts to crumble. And this is exactly why that's so terrifying for US policymakers. I mean, just look at this number. Over $33 trillion in national debt. A number that big is only manageable as long as the rest of the world is basically forced to help you pay for it. The moment that demand wavers, the consequences are just enormous. And this slide really puts it in perspective. For every single percentage point that US borrowing costs go up, just 1%, it adds over $330 billion to the annual interest payment. That's money that can't be spent on anything else. Not infrastructure, not defense, not healthcare. That is the price you pay when the loop breaks. Now, you're probably thinking the US is going to be the first to feel the pain. But that's actually what most of the coverage on this topic gets wrong. The first and most brutal impacts are felt somewhere else entirely. Developing nations get hit first, and they get hit hard. Most of the world's essential goods, we're talking food, fuel, medicine, they're all priced in dollars. So when the dollar starts swinging like crazy, so do the prices of those essential imports. At the same time, their local currencies get crushed, and any debt they owe in dollars suddenly becomes impossible to repay. They are plunged into a devastating crisis that they had absolutely no part in creating. And that's the deep irony here, isn't it? The countries that benefited the least from this whole era of dollar dominance are the very same ones who suffer the most when it collapses. It's a classic story of how these big power structures work. So, with the world in chaos, all eyes turn back to the United States, which now finds itself staring down a dilemma where there are frankly no good options. The US has 2 terrible choices. Option 1, defend the dollar.
They could jack up interest rates aggressively to make it more attractive to own dollars again. But the consequence of that would be crushing the US economy and triggering a deep, immediate recession. Okay, so option 2, just let the dollar fall. But that means everything America buys from other countries, all those electronics, all those car parts, all those medicines, gets way more expensive, leading to massive inflation at home. It's a choice between recession and inflation. There's no door number 3 that avoids the pain.
So let's hit fast forward. Let's assume the initial crisis eventually calms down. What does this new world actually look like after the dust settles? It's not just about what was lost, it's also about what gets created. We'd almost certainly end up in what people call a multipolar currency world. Sounds complicated, but it just means there's more than one big player. Trade between China and its partners might settle in yuan. Europe keeps using the euro. The dollar is still powerful, maybe even the most powerful, but it's just one of several options. It's no longer the entire operating system for the world's finances. And that means more complexity, more negotiation, and the end of one country setting all the rules. And that right there is the fundamental trade-off. In this new world, smaller countries get more financial freedom. No single nation can use its currency as a weapon to dominate everyone else. But the system is also more complex, probably more fragile, and a lot less predictable. So a world with fairer rules might also be a world that's less stable. We're basically trading a simple, if unequal, system for one that's more equitable, but a lot harder to navigate.
So look, we've been talking in hypotheticals this whole time, but now we have to connect this back to reality. Because while the exact scenario we laid out was a story, every single one of its components is very, very real.
Just look at the headlines. The BRICS nations are actively, publicly talking about creating a new currency. Saudi Arabia is making huge moves to diversify its economy away from just oil and the US. The American national debt is a political firestorm every single day. Every single mechanism we've described in this explainer is already in motion right now as we speak. So the real takeaway here isn't about trying to predict a collapse. The question isn't if the system's going to change, it already is changing. The real questions are, how fast is it going to happen? How disruptive is it going to be? And can we manage this transition to build a more balanced, more equitable global financial system to take its place? The fundamental architecture of our